everybody. Welcome to another episode of 10,000 Roads to Financial Independence. Today, I have Kent Ritter. Kent is on a mission to create modern, affordable housing for America's workforce while empowering others to take control of their financial future through real estate investing. He's the CEO of Hudson Investing and since 2019 has acquired 440 units valued at $33 million. Additionally, Kent was also a partner and led a private selected business unit within the multifamily private equity firm Bridge and Management. Bridge and Held currently has over $1.5 billion AMU. Prior to his real estate career, Kent was a partner in a management consultant firm where he played a central role in growing the business to 95 employees and $30 million in revenue in 5 years. His strong analytical background, experience managing multi-million dollar projects and business, gained as a startup leader and a corporate executive, give him a competitive edge as a real estate investor. He's blessed with an incredible wife, 2 daughters, and a son lived in Indianapolis. So welcome, Ken, very much to our show today.
Thanks, Lisa. Happy to be here. Thanks for having me on.
Awesome. And Ken and I have met each other through a event about a couple years ago, perhaps a Gino event or so. And then since then, we've been kind of in and out, keeping each other in catch. And it was really good to catch up with him in our show today. So Ken, we always ask our folks, our person who comes in, our guest, one question to start our show. Which is when you think back in your childhood as you're growing up, who has influenced you most to become the entrepreneur who you are today?
Yeah, that is a really good question. There isn't necessarily one person that I can really highlight to say like, yeah, this was it. But as early as I can remember, I remember when people asked me what I wanted to do, it was own my own business or be a CEO or kind of just be the leader of the business, right? I mean, even when I was a little kid, before I even really knew what an entrepreneur was. And so I think that a lot of that came from just growing up. I grew up, pretty blue collar. My mom was a teacher. My dad was an insurance adjuster actually. And we were pretty modest and I saw kind of, the cap on, we had everything we needed, but I also saw the cap. I saw how others around me were living, how friends were living. And I knew that I just wanted something more. I also just always had it in my mind that I wanted to kind of be in control and be the leader, I guess. And that was what I've always really valued, that attribute of people that can be, strong leaders and be successful. And so, probably coming from my parents, maybe more from seeing their example and understanding how I wanted to do things differently. I'm sure started to frame that when I was young, but I just remember from the very beginning wanting to have my own business. And people would ask me, I'd say, well, I don't know yet, like what it's going to be, but I'm going to own something.
Right. Yeah, definitely. That's awesome. And you basically is your kind of growing up, the path is going to kind of college, get a job, etc. Now, when did you kind of dabbled in or rekindled your spirits of entrepreneurship? A moment of a transition when that kind of come back to you?
Yeah, I mean, so I'd say the spirit of entrepreneurship never really died. I did, go through school, went to college, got a finance and economics degree, and always had this idea that I was going to, again, own my own business. And even in college, I didn't know exactly what that business should be yet.
Right.
But the way I looked at college was I wanted to set myself up to be successful for whatever that business is to come. And the clearest path I thought to be able to really understand how businesses work and what makes them succeed and fail was to become a management consultant.
Mhm.
Because that's what management consultants do, right? That clients hire us and we help them solve their problems. And so I was able to see over a 12-year career, hundreds of different businesses, what worked, what didn't, kind of, through that identify the common themes that I'd say make businesses work and don't. and really give me a framework for how to run a successful business. And so that was really how I looked at college and how I looked at my initial career and said, okay, I think I'll do that for like 3, maybe 5 years, and I'll go off and I'll start my own business. Well, I stayed in it for 12 years, but for the last, I guess the middle of it actually, I went to go work for a firm. And then a few colleagues and I left that firm in 2010 and when we started our own consulting firm. It was a boutique consulting firm based in Chicago. We ran that until 2015, and per the bio, you heard the growth there. Got it to 30 million in annual revenue, and then decided it was time to sell. And so we sold that at the end of 2015, and that then is what really kicked off my real estate career. As I was going through my earnout from selling that business, had a couple of years where I needed to work for the company. I really spent a lot of time ramping up and learning about real estate and really got interested in real estate investing. And so that was when I really started investing, was in 15, and it was really passively investing at first with others to really just understand how all this works.
Yeah, that's awesome. Now, how many projects do you have invested passively, and then what are some of the learnings that you gained from there, throughout the years?
Yeah, passively, I think I'm up to 13 projects at
Yeah,
this point. Yeah, it might be 14, but we're around there. And some of the things that I've learned, well, there's a lot of good lessons. One is 100%. It starts with the sponsor. The sponsor is the most important thing, right? A good sponsor can save a bad deal, and a bad sponsor can kill a good deal. And I had that experience to the utmost extreme, where I had a sponsor that I invested in actually commit fraud, and I lost a good chunk of money in that process. That was one of the first investments I ever made through a crowdfunding site, and it was really, shame on me for not doing the due diligence on the sponsor that I should have. And I don't know that there would have been indicators that
right.
he was a bad guy, but maybe I would have found something. I can tell you, I didn't do anything. I didn't do anything related to the sponsor. And so for me, and that's what I try to really educate people on now, is do your due diligence on the sponsor. Look for integrity, look for track record, look for decent financial means themselves so that they can support a deal if it does go south for a while. And look for a willingness to put skin in the game. I mean, those are the things that I look for in a sponsor. Somebody that's going to invest right alongside me. I mean, I wouldn't invest in a deal if somebody came to me and said, "Hey, this is a great deal. You should invest in it." Like, I'm not going to invest in it, but you really should. You definitely should, right? So I've defined kind of those 4 criteria now, and as I still invest passively, because I don't invest passively in multifamily anymore, because I run my own deals now, and we're on our 7th at this point. But I still invest passively in other asset classes like industrial and medical office and storage and places where I'm not the expert, but I want the exposure.
Yeah, definitely, definitely. And now you mentioned about finding these deals through crowdfunding versus in our traditional senses, you actually get to know the syndicator and invest with them. Now, do you have a preference between the two? Because oftentimes we get passive investor asking about like, hey, what's the difference between a crowdfunding platform versus just simply go and find who is the right syndicators and invest with them directly. What do you have any suggestions for our listener who are kind of thinking about that?
Absolutely. I mean, just the fact that so with a crowdfunding site, it's difficult to really vet the sponsor, is what I found. It's difficult to get them, on the phone and be able to have a discussion
Uh-huh.
and really get that gut check, right? Of do I resonate with this person? Is this someone that I could picture myself doing business with and trusting to hand over a significant amount of money to, right? And so for crowdfunding, that I think that's one of the biggest limitations for me. And I mean, in my opinion, it's much better to build a personal relationship with a sponsor. And so I started out on crowdfunding. That was me dipping my toe in 2015
Right.
when things were all still very new. But as I began to network and attend conferences and make relationships, I don't do any crowdfunding anymore. I just go to the sponsors that I have relationships with and know well. And it's really more, this whole game should be more of a long-term relationship process, not a transactional business, which I think those crowdfunding sites can kind of boil things down to at times.
Yeah.
Um, So yeah, I think it's all about, just going back to the sponsor, trusting the sponsor, verifying that what they're saying is true, and validating that there's somebody that you give your money to. And I don't think you can do that without having, one or a couple of conversations with them.
Yeah, definitely, definitely. So now switching gear a little bit, it's very interesting because we're a show about not just investing, but also growing your entrepreneurship. What kind of skill set or key areas like is there a crucial moment or maybe there's a couple moments back in the days when you're building that consultant firm to a 95 people employee, which is a big operation, coming from one or two people, and then $30 million revenue. Can you kind of tease out a few things for folks who's kind of getting into their zone, thinking about entrepreneurship? What are some crucial moments that help you growing to that level?
Oh man, there's a lot to unpack there over like 5, 6 years of business, but crucial moments. So I could say it starts with a partnership. You have to have a strong partnership. You all have to have your interest in line, and you have to again. I mean, just like what I talked about that sponsor, you got to know that they're good people, right, and that they're people that you're going to be able to trust. I think that's where a lot of people go wrong is they get into bad partnerships or maybe partnerships they haven't vetted out quite enough. I mean, you should enter a partnership like you enter a marriage. And I hope before you get married, you're having conversations about things like finances and
Yeah,
long-term plans. And,
yeah,
if one of you wants to end up in California and the other one wants to end up in New York, like that's not going to work out well at some point, right? And so same things with going into a partnership. If somebody wants to grow $1 billion business and the other person wants just kind of a lifestyle company where they can play golf 4 days a week, like those interests aren't aligned, right? So I think it starts with vetting out your partnership and making sure that you're in a good partnership and your guys' goals are aligned. I think that's where everything starts. From there, as far as just like tips for entrepreneurs, I think get your books right from the beginning. It's going to cost you more, right, to hire a bookkeeper from the start, but it's going to be well worth it. It's a heck of a lot more costly to have to go back and um, redo your books. And if you ever want to sell your company in a meaningful way, you're going to want your books to be GAAP compliant. And that's something that is also quite expensive, and you have to have audits and do all these things. But we did those things in our business because we always had an eye on selling at one point. And so we were probably way more sophisticated in our accounting than we needed to be, but it ultimately paid off when it was time to sell, and we had years of clean books that were audited and were GAAP compliant. So that's a big one. And then I guess the two things that I think really make or break businesses, and this goes back to my consulting side too, is you've got to have a solid org chart, and then you've got to have a solid set of standard operating procedures. Because the things that kill businesses are ambiguity and variation. And so you have to remove the ambiguity, right, by having clear delineations of responsibility, clear understanding of role, clear incentives that are aligned to what you want those people to do, clear measurement on how you're measuring what are the measurements for success, right, that they'll be incentivized on. And then standard procedures for everything that you do. And the more that you can do that in your business, the faster your business can grow, and the more that you can maintain quality while it grows. Because I mean, those are always competing forces: growth and quality. And so you've got to strike a balance there. And so those are, I guess, just some high level tips.
oh,
But
that's a lot
yeah,
of good things to unpack over there. Now, you mentioned about the partnerships. Let's kind of go back a little bit more over here. And I see every single thing that you mentioned over here by picking your right partner. That's like kind of step number one, getting your books right, selling your company, always have eyes on your goal, and then having solid org charts and operation manual. All these transition into any type of business. And I definitely think you're going to have really successful, you already have very successful real estate investing firm. Now you're just translating that now into growing that even more. So this is like a really really great stuff. And so yeah, and then by just kind of going back to some of the stuff you were saying is like, so picking the right partner, did you always pick the right partners? Is there any incidences where it may seems to be the right idea, but then somehow people kind of grow apart and whatnot. And how do you actually like kind of mitigate the bad partnerships or, just simply people kind of growing apart? Yeah.
Yeah, no, I've not always picked the right partners. I think everybody goes through that, right? But I could say with my consulting business, the way that it was able to grow so quickly um, was because of the partnership. And there at the end of the day, there were six of us,
Mhm.
and we all had different roles, and we all were able to own our swim lanes, and we were all able to trust each other that we were going to get done what needed to get done.
Right.
And so that really was, I think, a very unique thing to come together with that many people and have it work. And I didn't recognize that at the time because it just kind of organically happened and worked.
Yeah.
But now, just hearing other people's stories and looking at entering other partnerships through different real estate deals and things. I mean, I think that was really an odd thing for it to come together so well like that, and really kind of a unicorn event.
Yeah.
But yeah, I mean, I wouldn't say I've entered into any bad partnerships since then, because I entered partnerships very slowly. And so, but there's been a couple, two I can think of right away where I avoided
Yeah.
partnering. And luckily, we went through kind of a honeymoon phase, and before really signing the paperwork, and luckily, after the honeymoon, things were so sweet. So
Uh-huh.
um, it was able to really kind of vet that out before really really locking in with somebody. And one of the things I like about the real estate business and what we do is you can partner on individual deals, not necessarily in a business for the 30-year long term. And so it gives you the ability to really vet people out and really understand if it's somebody that you would want to partner with. But I think in general, everybody, I mean, I'm sure I'm guilty of this too, but everyone kind of overvalues their skill set and the attributes that they can bring to a partnership. And so I think it's important to really get to like the nitty gritty and really get some examples of, when it gets down to it, who's gonna be working hard, who wants to go play golf, and understand those things, and like get a couple examples of real process before you sign up for that long term partnership.
Right. That's a great, great.
I like, just like another example I give is like I had an example of somebody who thought they could just raise millions and millions of dollars because they knew a lot of rich people.
Right.
And at the end of the day, he couldn't really raise squat. And the whole partnership was going to be predicated on him focusing on capital raising. And luckily we kind of tested it before, and he came back and said, wow, this is a lot harder than I thought it was going to be. And I said, yeah, it is. And so I think just again, just kind of trust but verify, right? Trust but verify before you sign up.
Yeah, absolutely. I think that's great. And then I think it's great advice over there is if you're thinking about creating a real estate firm, perhaps want to start it with a few deals, and every deal is a different structure. And then once you kind of get a rhythm going, and then that's kind of the time to thinking about, hey, is this suitable for a long-term partnerships over here, going more exclusives? Don't have to kind of jump into it. Six people is a lot, like for that firms that you guys are working on the partnerships on that for sure. Okay, so now kind of switching gear into the real estate investing, how did you kind of got into the syndication? And looking back, would you kind of do the same path? Yeah.
Yeah, I would. I mean, I spent probably more time than most just trying to build up an education. I mean, I'm the type of person that, like, if I'm gonna go out and buy a TV, and my wife loves slash hates this about me, is if I'm gonna buy a TV, I'm gonna look at like 40 TVs to know and I'm gonna get like the best TV, and that's just the type of person I am. Like, I want to know everything, every aspect. Like, I was just driving my insurance broker crazy on the phone yesterday because he's like putting these policies in front of me, and I'm like, I got to know the details. Like, what's this? What's that? What this? And but that's how I buy, and that's kind of how I do everything. I think the devil's in the details, right?
Yeah.
And so I went from 2015, my first passive investment, to 2019, really about 4.5 years before I actually like led my first syndication. And even that one, I was a co-sponsor where I would say I was more sitting shotgun than leading, right? I was really learning from folks that had more experience. So I think that's a relatively long in like real estate syndication terms before somebody actually goes out and does their own deal. But
Right.
I just felt like there was a lot that I didn't know. I mean, real estate was new to me, right? I was coming out of a career in management consulting, but I'd never been a real estate investor. Um, and I felt like even more than I knew I didn't know, there's probably a whole hell of a lot I didn't even know I didn't know. Right. And so that's why I signed up for a couple of mentorship programs. Like one of them was where we met originally. Went through a couple of those, just every book and podcast I could devour. And still have a few mentors today that I really, and some are paid, some are unpaid, that I use that are really kind of my backstops to avoid making those big mistakes. And so, no, I wouldn't do anything differently. I think every step that I did, even going to work for the private equity firm with 15,000 units, was kind of what I saw as like my real estate MBA, to go and see how a group that's been extremely successful does it at a very high level. And I spent a year there, and it was a great education
Yeah.
on how to do things. I'm able to take those things and carry forward. So I think every step in the process was thought out, and I wouldn't do things differently now, because I think it's given me a really solid base to build this company off of now, and amazing connections at all different levels of kind of operations and financing and everything really.
Yeah, definitely. And so working for the asset management firm, I think that's great because everything what you just told me is just displayed how thorough you are with the approach to life. And oftentimes us entrepreneurs gets really excited about something, so we just kind of go head first. That's definitely admire people who like you who really thoroughly like plan out everything there. So what are some big tips that you have learned from working for a firm that owns billions of assets? And then what are some of these that you're going to take into your investment or have already implemented into your investment firms?
Yeah, that's a really good question. One is that vertical integration has its pros and cons.
Yeah,
I think typically all you ever hear are the positives of vertical integration, and people really tout that as, oh, we have our own property management company, we have this, we have that.
yeah,
Um, Being able to see a firm that it was totally fully integrated,
right,
vertically integrated from purchase to construction to property management, even on the even having their own people sourcing financing, insurance, materials, like everything. It's extremely sophisticated. At the same time, there's something to be said about specificity of focus.
yeah,
And there's something I used to tell my consulting teams, which was like, you can't be productive if you're working on too many things. Like, I'd rather you move a mile in one direction than move an inch in 1,000 directions,
right,
right? And it's kind of the same thing. If you're focused on too many things,
yeah,
too many balls in the air, it's tough to really prioritize, right? And so I saw that some.
yeah,
The other thing I think is it's difficult to it's if you have a third party management company that you can fire based on non-performance, then you can really hold them accountable,
right,
and you can really choose the right firm for the right application, right? Because some property management firms are good at big Class A projects, others are good at small C class projects, and anywhere in between. When you have your own, you kind of have your, and you have to use them. It's kind of like that is the only option, and it can be difficult at times to get accountability because you can't fire yourself.
right,
You can fire individuals, but it really comes down to the leadership and the ability to hold those folks accountable. And I saw at times issues there.
right,
So I think those were just seeing the kind of the pros and cons side of the vertical integration model. Um, and but some of the good things I saw were just the sophistication that they took related to market research and the tools that they used, and related to underwriting. I mean, a 50-page underwriting spreadsheet with way more detailed than anything I'd ever seen put out by, some of the guru teams or different things that really let you get to like exactly when everything's going to happen and really dial in, which, I'm a detailed person, so I like that.
Right.
Right. The sophistication of how they approach financing at like a portfolio level, not just an individual deal, but how they manage across 60 plus projects, right? Liquidity and cash flow and, their different exposure to different areas. I mean, all of that. And then sophistication on how they put their insurance together. I mean, insurance is one of the biggest costs and it's only growing. And so by being able to create master policies and do different things, they were able to save a lot that makes them more competitive on individual deals because they have kind of a set price across their whole portfolio versus a deal by deal basis. So those things I think do give a competitive advantage and were great lessons that I learned.
That's fantastic because I just learned so much from like this session as well from you, Ken. What do you see the uniqueness of these markets versus, let's say, coastal or some of the big metros? Yeah.
Yeah, I think there's a lot of unique characteristics. One is just lack of competition, not lack of, but less competition, right? I mean, the markets that everybody's investing in are just that, the markets everybody's investing in, and every new syndicator is being pushed toward those markets. If you think Florida, Dallas, Phoenix, right, even Vegas, Atlanta, these markets are performing extremely well, right, from a rent growth standpoint, population growth standpoint, all that, but they're also hyper saturated there's just 30 people like me on every deal trying to buy every deal, and I think it makes it difficult to be able to pay the right price. And I'm not a high cap rate person. Like, to me, cap rates are not good or bad.
Right.
I mean, some people think 3 caps are bad. Cap rates aren't bad. They just are what they are. You just have to change your strategy based on what the cap rate is. I mean, you said you were doing projects in Phoenix. Those are probably 3.5 caps. And like you said, there's not a bunch of cash flow at the beginning, but for every dollar you put into the property, right, and raise an OI, you're going to get a better return. So cap rates aren't good or bad. That being said, the Midwest has relatively higher cap rates, which equate to relatively stronger cash flow yields, right? So our projects still, very much have strong cash flow, 7, 8, 9% year one. Average cash flows in the 9 plus to even 10, 11, the double digit range from a average cash flow basis for cash on cash. And so for cash flow investors, that's a real positive in the Midwest.
Right.
I think, additionally, the Midwest doesn't follow the same cycles as many as the coasts, especially, but even as some of the hotter markets. Phoenix is up huge. Phoenix was also one of the hardest hit during '08, and Vegas as well. And that's why they're a little bit behind the curve of coming up, because they were so far down. And yeah, they're coming up, but it's just it's a cyclical place, right? Where Midwest is kind of steady Eddie, slow growth upward. Yeah. And slow growth used to be 2-3%. I mean, we're seeing 5-6% rent growth in the Midwest even at this point. In some of our properties, we're seeing even more down in Kentucky and over in Ohio. And so, but traditionally the Midwest has been about stability. It's been about, good cash flow. It's been about, really steady job environment. If you take Illinois out of the picture, it's a very pro-business, very pro-landlord environment. It's easy to evict. There's low taxes. And so those things are all really positive. And then from a city standpoint, I mean, we look for cities where there's good job diversity, good job growth. I mean, jobs are the number one reason people live where they live, right? People live because where they're going to work. The only other reason they live there is because it's close to, they want their kids to go to a certain school, right? But jobs are number one. So you got to follow job growth. And, the Midwest has seen great job growth, especially in the logistics field, because we're so centrally located, right? Like, there's a stat that from Indianapolis, you can reach 75% of the US in one day. And so we've got, Walmart distribution centers, Amazon distribution centers. Louisville, Kentucky is the North America headquarters for UPS, with their big world port there. Indianapolis has the second largest FedEx facility in the world. So there's a lot that's going on from a logistics standpoint that have really been a boon to the economies. And we've also benefited from this remote work environment where folks
Right,
can leave the coastal cities and move to more affordable locations.
right.
And we're seeing a lot of tech jobs move into places like Indianapolis. The tech job growth has been pretty extreme because of that, because they can keep their job and live in a more cost effective place.
Right. Yeah, definitely. And then so what do you have envisioned 5 years, 7 years from here on, whatever the midterm goals are for your new business, for your investment business. Yeah.
Yeah, that's a good question. As far as goals, it's really for me now about creating a standard repeatable process, right? Which we talked about, which so in everything that I do, we're creating templates so that we can do it better and faster the next time, right? So you lay that foundation, and then in 5 years, I'd like to have moving from largely using contractors now to having more of a dedicated team, bringing some of that in house, and really having a team where, I'm able to step out of a lot of the day to day and really lead more from a strategic standpoint. Having a director of acquisitions, a director of marketing, director of investor relations, and putting that structure into place
Mhm.
that allows me to step out again a lot of that day to day activity and be more strategic.
Yeah.
And so my goal is to spend less time in the business and more time on the business
Right.
as we continue to grow. And so that's how I'm developing the business from the very beginning is really to replace myself in all of those roles.
Yeah, that's awesome. That's awesome. Now, that's kind of a great transition into like the family aspect. You have three kids. We always ask our guests, how do you actually help them to be more financially literate, to be more become entrepreneurship or just being financially more literate for your kids? What do you do with them?
Yeah, well, they're pretty small. They're 5, 4, and 2. So they're just now, my like they don't exactly understand what I do. They know I'm around a lot. They know I work in the basement, right? I don't go into an office every day, but I think they're just kind of getting my 5 year old, probably just getting to the point where she can start to understand some of those things. But as they get older, I the most important thing for me from a kind of I guess business side of things is to impart my knowledge on them and just my perspective of being an entrepreneur and being your own boss. And I'll be happy with whatever career they go after. I mean, they may not have the same kind of entrepreneurial drive that I do, and that's okay. But if they do, I'll definitely support that and want them to just understand, I think, basics of like, God, who knows how much college is going to cost by the time they're there
Yeah.
in like 12 more years. But I don't know if I can't imagine that's going to be worth it. Maybe it will if they want to be a doctor, but other than that, I think there's a lot of ways to learn what you want to do. I think college is a great experience if you want to kind of find yourself and just have a lot of fun, but
Yeah.
I don't know if the return on the investment's there. So I think that'll be I don't think it's as clear cut as it used to be. Right. I think that, I want to teach them to have multiple streams of income, right? Always have a plan B, never be beholden to one job or one employer, always have options,
Yeah.
and teach them how to develop that portfolio. And then I think just teach them how to be smart financially. I think so many people don't even know how to like balance a budget or create a budget or like manage your own personal finances or how to get a mortgage or how to like all these things that are so basic to our life, but like no, we're never taught them. Like everybody has to figure that stuff out on their own for the most part.
Yeah.
And so I think just bringing some of that baseline literacy will be extremely important. And then just giving them the mindset that they can do whatever they want.
Yeah.
I mean, that's really critical to me is there's no limitations. The only limitations you have are the ones you put on yourself. And
Yeah.
like my daughter at this point, I love it because she's like, she wants to be like a baby doctor, an animal doctor, a ballerina, like an astronaut sometimes. It's like, if you want to do all those things, you do all those things. Like you could do it,
Yeah.
And I think I think our ambition and our imagination gets pushed down by school and by well-meaning parents and by others saying, "Oh, you need to be more realistic." Blah blah blah. It's like I don't think so.
Really.
I think you should be completely unrealistic and with what your goals are.
Yeah, I love it. Love it. And the last question we have is, how do you balance work life? How is that like lifestyle for you right now? How do you, because as driven entrepreneurs, we tend to work very, very much because this is what drives us, is what really interesting to us. How do you kind of balance that with your family?
Yeah, yeah. My wife's good at holding me accountable to this, and we try to do a lot of pre planning so that I can get the time in that I need. But essentially, it's I mean, just get my day to day rundown is you get up about 6. Get ready. The kids get up at 6:30. We get the kids off to school. About 8 o'clock, from 8 to 5, I'm working. At 5, I shut it off. Try to spend from like 5 to 8 with kids and family. Really try not to be on calls and things if I don't have to be, so I can really have that dedicated time. And then at 8 o'clock, or as soon as we get the kids down, it could be 9:30, who knows. Usually I'm popping the laptop back open and trying to take care of some other things, whether it's related to my podcast or other ancillary things I'm doing. So, I probably work 10, 11-hour days for the most part. Usually a couple hours, on the weekends. But, I think it's less about the quantity of time you spend and more about the quality of the time that you spend. So I think being able to put the phone down, really trying to be mindful about putting my phone down and just like putting it on the other side of the room and not having it when I'm with the kids.
Yeah.
Cause like, you can be there physically, but if you're not really there paying attention, like it doesn't really matter if they just see you on your phone all the time. I think that's a terrible example to set. So right now it's more about the quality than the quantity of time with them. But look, that's you said 5 to 7 year plan. My 5 to 7 year plan is to have more time with the family as I get the business to a place where it can run a lot on its own.
Yeah, definitely. Well, awesome, Ken. This is a great, great session. Have you over here with us today. And we're just gonna wrap this episode up. So thank you so much for your time today. Yeah.
Yeah, Lisa, thank you so much for having me on. It was good to catch up and share some of my stories. So hope everybody enjoyed it. And if folks want to learn more about me, they can go to kentritter.com. Check out my website. You can sign up for our newsletter to be an investor. You can check out my podcast as well. It's called Ritter on Real Estate. And so, yeah, appreciate the time to be on and hope we stay in touch.
Yeah, that's awesome. And we're gonna be putting all that in the show notes as well, for you to find a way to reach to Ken. All right, thank you so much.
Awesome. Thanks, everybody. Have a good day.